and we'll jump right in. And this should take around 20 or 25 minutes. And if you submit questions to the chat box, Cassandra can read them to me later. Now, I'm going to take a couple of minutes to, well, first of all, let me take a minute to tell you where I get my perspective. The company I work for is the world's largest provider of trade credit insurance. And basically the way it works is if you manufacture goods and you sell them to another company, you hope to get paid back in 30 or 60 days. But if that company goes bankrupt, for instance, and doesn't pay you back, we insure you against that. We insure you against non-payment. So bankruptcies, the condition of the economy, is very important to us. We've been around for over 100 years. We're AA rated by S&P. We have offices in 52 countries around the world. We are owned by the Allianz Group, probably the world's largest provider of financial services. We have 6,000 employees and 52,000 clients worldwide. We insure $150 billion of sales here in the US and $1 trillion globally, and we pay 85,000 claims a year. Now, protection against non-payment is one of our benefits. A lot of our clients use us for safer sales growth, because if you want to sell into a market that you don't know about or sell to somebody you don't know about, we probably do, because we have a database of over 85 million companies worldwide. So it's very briefly who we are. Now, I do want to review 2020 for a minute, because I think it's important to see just how precipitous it was, and how, in a sense, we were lucky to get out. So let me start off by the employment picture. We know that, I guess it was in the middle of March, a national emergency was declared. Non-essential employees were laid off. And we saw something unprecedented. And over here, there we go, we see incredibly rapid job destruction. So this is the number of jobs created since the Great Recession 10 years ago. And you can see we created 5, 10, 15, 20, 23 million jobs in 10 years. And they were all wiped out in 5 weeks. I mean, that's really an incredible thing to think about. The chart in the middle shows the number of people who are still on unemployment rolls. Well, it's come down from the peak, but it's still 7 times the historical average. 7% is a big number in economics. This is 7 times. So we're, really in an incredible situation. And the GDP hit in the second quarter is minus 31% annualized. Well, look, this is the Great Recession by comparison. How bad that was? Not even close. This was the previous record, minus 10%. So as I say across the top, it wasn't unprecedented. It's something completely different. And if we look at the jobs created and lost, this is an 80-year chart. These are the jobs we lost in March and April, minus 21 million jobs. By comparison, again, that's the Great Recession. You can barely see it. Here's the previous record when industrial production stopped after World War II. I mean, something completely different than what we'd been seeing before. And as a result, personal consumption, which is 70% of the economy, also took a giant hit, 12% down in April. Previous record here at minus 2%, and you can, relatively speaking, can hardly see it. And that's a 60-year chart. But we did get a boost to income from the CARES Act in April, and that's actually why we were able to get some of that consumption back in May and June. This boost to the CARES Act was critical to helping save the economy. I'm not a big fan of government spending, but this is a case where, this wasn't from excessive risk-taking that people were doing. People needed help, and I think that was the right thing to do. But ever since then, the economy has been slowing. For instance, jobs created, you can see, has been slowing every month since then. Now, this red bar here, that's going to come out tomorrow at 8:30 in the morning. This is the government's big employment report. It comes out on the first Friday of every month at 8:30 in the morning. It's the most important economic release by far in the world. If you watch CNBC, they actually have a countdown to the last second as when the number is going to be released. And there's a pretty good chance that'll be negative tomorrow. So and that's because of all the recent shutdowns we've had in November and in December. So that's really going to be a step back for us. But we kind of expect it, and we hope that when those shutdowns are eased up later this year, those will come back. As I say, all across these charts, things have been slowing. Here's that income from the CARES Act, well, ever since then down. And here's that consumption again, 70% of the economy actually did go negative in November. So we're definitely seeing a slowdown again. The most important part here, I think, is jobs. We still have 10 million people unemployed that did have a job last year. And the question is, when are we going to get those jobs back? And we can go back and historically and look at previous recessions. Now, this chart shows each recessions in the past. Each line is a different recession. The black line is the 1980 recession, for instance. You can see in that recession, we lost, 1 million jobs, but we got them all back. We came back to zero in about 11 months. The worst one was this tan line, the Great Recession. We lost 9 million jobs, and it took us almost 6 years to get them all back. And here's where we are today. Obviously, again, a dramatic drop off. We've only recovered a little bit more than half of the jobs we lost. This table just shows the data in the charts, and it shows that on average, it takes around 3 years to get all the jobs back. So that's 2023 before we come back to some semblance of full employment, and that's really the most important part. You know, other measures are important as well, but we have to have people working. Now, because consumption and income have dropping off so much, and we might actually get a negative job report tomorrow, small business in particular is very much at risk. Without going into detail on this chart, basically it says that on average, the average small business has 27 days to live if revenue stops coming in the door. Very, very close to the edge. We can see that a lot of small businesses already have permanently closed. Over in the chart on the right, for instance, travel and hospitality, 62% have permanently closed. And that's the trouble I'm concerned about. If we do another broad-based shutdown, we'll see more permanent job closures, and we'll dig in an even deeper hole. So that's the problem in the intermediate term. I do want to show you one long-term problem. Yes, we had that CARES Act that really helped. Yes, we had that $900 billion stimulus package that just passed. Those will cause a problem in the long term, because to do that, we've had to incur more debt. This chart goes from World War II out to 2030. By then, we will have more debt than in World War II. And this is shown as the debt to GDP ratio, because we're going to have $38 trillion out here in debt. Well, I don't know. How big is $38 trillion? It's impossible to think of. But if you compare it to the size of the economy, it's like gross domestic product. GDP, that's everything that's produced by the economy. That's why it's a product. That gives us an idea of how this compares to the size of the economy. It's going to be 124% if we're lucky, $38 trillion. There's no plan to bring this down, and that's largely because we can't cut entitlement programs. Now, this looks like a disaster. It's very much not good, but we can sustain high debt levels for a long time. For instance, Japan has a debt level that's twice as big as ours. We're still the world's largest economy. We still have the reserve currency. It's a trade-off. Japan, the growth rate in Japan is close to zero. So the trade-off is we incur more debt, our growth rate will slow. That's the trade-off on fiscal program. Here's where I see the real problem, which is Federal Reserve policy. Incredibly loose policy over the 10 years of 0% rates, and endless money printing. Here's the blue line is the Fed policy rate back down to 0. And you can see where it's been historically. Now we're at 0. And this brown area here is what's known as the Fed's balance sheet. It's basically the amount of money they make available to the economy. And that's clearly spiraled way out of control. This is a formula of too much easy money for too long, and it will lead to tears at some point. That's my real concern in the long term. But let's focus today on the intermediate term. And that's why I want to look at some COVID statistics just from yesterday. So the chart on the left is the daily new cases. We can see that the third wave in the US here started in September. Gee, it looked kind of hopeful here a few weeks ago, but no, we've had a resurgence, and I don't know, I'm not a health expert. One guess might be holidays, particularly Thanksgiving at this point. That might be the cause of it. Now, over on the right is the cases per million. You know, the US is the third largest population in the world. Of course, we have the most cases, if you will. This is cases per million, adjusted for the population. And you can see here in the UK, things are really getting out of control. So they're going to actually their third major lockdown. We're still not good. We're still on the rise, but by comparison, it's not nearly as bad when you adjust for population. Part of what drives this is the positivity rate we're getting from the tests. And I see I've got a little sunshine on my cheek. It'll go away at some point because it's going through the window. But the positivity rate is driving this. This is the amount, portion of tests that come out positive. The red line is the US, and you can see ever since September, it's going on an upward trajectory. It's fallen off a little bit, but I think the longer term from September to now kind of tells what the story is. We're getting more and more positive cases. We still are not in control of this at all. As a result, we see the chart on the right. Now, this chart shows hospitals under stress. This is the key here. This is the percentage of adult ICU beds with COVID-19 patients. The red here is 50-ish%, 50%. You can see in all these states that's the case. Here in Maryland, let's see, we're 20 to 30%. Also, this chart shows the states that have that thick outline on them. Those are states where 75% or more of ICU beds are occupied. So in Maryland, we have 75% of the ICU beds are occupied. This is a big stress on the hospital. And we know that in Easton, there is big stress in the hospital as well. So this is my concern. We still have rising cases, high positivity rates, hospitals under stress. We need to get this more under control. Well, guess what? We've got a vaccine. We've got 3 vaccines. It's really important to remember that we didn't have that just a few weeks ago. I mean, this was all of last year. I was saying this is the key to an economic recovery. We might not get it till the middle of 2021. We've got it now. And that's really a miracle. It took 11 months. On average, it's like 5 to 10 years to develop a vaccine. Chickenpox took 34 years. 36 years later, we still have no vaccine for HIV. The record beforehand was 4 years for months. This came out in about 10 or 11 months. Really, I would say a miracle to be grateful for. But the rollout is slow. That's a bit of the problem. It's going to get better, but it's a little bit slow right now. Now let's look at the global situation. These are the total doses administered. We've actually administered the most in the world. China's got a population 4 times as big, but we have administered the most in the world. But when you look at the population, adjusted for the population, again, the United States is the 3rd biggest population in the world, you see something really interesting. You see Israel is way out in front of things, way out in front of things. And I'll talk about why that is in a minute. The US, doses administered per 100, not too bad, especially when you compare it to the world average. So we're getting there. Now, if we look at the doses administered, the left, this is the rate on the right. The left is the total that have been administered so far. The rate is on the right, and we are administering rates fastest of anybody else, fastest of anybody else. But again, if we adjust for the population, you can see Israel is so far in front of everybody else compared to down here. Here's where everybody else is. Why is that? Well, basically, Israel has a centralized command, and I'll get back to this in a second. I want to show you something else first. Well, here it is. The trouble is the rollout is slow. And why was that? Look, first, it's only been 3 weeks. Let's give this a chance to work. People are screaming how bad it is already. It's been 3 weeks, and that included Christmas and New Year's. Of course, it's going to start slowly. And as we saw, compared to other countries, we're really not doing that badly. But there are difficulties, that need for ultra cold temperatures, the lack of staff. We have 17 million doses out there already, but only 31% of them actually been administered. The staff in hospitals are simply overwhelmed trying to take care of the sick people. And by the way, here in Maryland, we are right on target with the rest of the country. We're at 30%. Staff, again, having to take care of the sick. Distribution plans were left for the states to decide, so that has caused some problems. Unlike the flu vaccine, you have to sign up to get it. That's providing more administrative burdens. Providers are actually leaving some vaccines on the shelves rather than using them because they're waiting for the priority group. And many states have reserved vaccines for nursing homes, and that's taking time to roll out. And again, it's the third largest country by population and area. It takes time to get to everybody. So these are obstacles that we're going to overcome, but it's not surprising 3 weeks into it that, you know, we have a way to go. It's a key to get it out there, but it's got to get going. Again, here, why is Israel so successful? Well, all citizens over 18, all citizens are required to register with one of the country's 4 HMOs. Per highly digital system, basically everybody's accounted for, centralized command, and they're using Army medics. And they were an early bird in terms of they made deals with the drug makers early. And it's a very small country as well. Those are the things that really got them in front. Now, the table below simply shows a calculation of how long it's going to take us to get that, to herd immunity. Well, right now it's about 350,000 doses. Our population is 330 million. We take 75% of that, that's herd immunity. You do the calculations, that's 709 days or almost 2 years to get just one shot. Now, if we go up to 1 million a day, which Fauci says we can do, and I believe we can do, that's a rare bit of optimism there for me, but I believe we can do it. That gets us down to 0.7 years. That gets us down to the middle of the year. Now, here's a caveat. That's one shot. That's one shot. And I don't honestly know how much herd immunity that provides at that point. So we need this to really get up to 2 million a day. And I think we can do it. It's not manufacturing, it's delivery. Now, we need to, as I've mentioned here, a lot of providers are targeting audiences or groups, and that's the right thing to do, particularly frontline healthcare workers, but also by age. This, we can see already, we know COVID is highly concentrated in the old, the already sick, those in nursing homes. This chart shows how concentrated it is. The chart on the left is the Spanish flu. And the chart compares the proportion of population to deaths. So for instance, over in the left, down low, this is an age bucket of 14 years and younger. Well, during the Spanish flu, that's where 32% of the population was, 23% of the deaths. The next age bucket, 15 to 44, that's 47% of the population, 64% of the deaths. The point is, if you squint your eyes a little bit, the deaths are pretty proportionate to the population. Here's COVID, a totally different situation. 14 years and younger, that's where 19% of the population is, virtually no deaths. 15 to 44, 40% of the population, 2.5% of the deaths. It's this group, 65 and older, that's 16% of the population that accounts for 81% of the deaths. This is the target that we should be looking at after the frontline workers. If we can do that, it means we won't have to shut down the economy all the way again, which we saw was really so disastrous because it resulted in permanent job loss. There are 3.7 million people now who are saying, my job's gone. My job's gone for good. And at the same time, we have people that could be evicted. The moratorium on eviction ends at the end of this month. This chart says the people, it's a survey by income. People that are earning less than $25,000 a year, say 1.5 million, almost 2 million of them are saying, I think it's, it's the orange line. In that income bracket, 1.7 million people are saying it's very or somewhat likely I will be evicted. In the next age bracket, 1 million people are saying it's very or somewhat likely. This is shocking. This is shocking. And I think that we're probably going to have a change to this law again and some more relief to prevent this from happening. But this is what we have to have happen, is prevent this permanent job loss. So it's been a grim story. We need to get through, we need to ramp up production. We're not there yet, but it's not hopeless either. That's part of the story. There are some good parts of the story as well. For instance, the housing market has been roaring and will continue to roar. People want to get out of the cities. Here's an index of mortgage applications. Each line is a different year. Blue line is this year. We're well above any of the previous years, and why not? Chart in the middle shows the 30-year mortgage rate. I mean, look at that. That's historical lows. This goes back into the 70s. Look at what it was in the 80s, 18%. Now we're down to basically, 2.5%. Record lows. And some measures here on the right of the housing market include new home sales, that green line, well, they're higher than before the pandemic. Existing home sales, the tan line, higher than before the pandemic. And permits to build, higher than before the pandemic. So housing's looking good, and there's some other leading indicators that look good as well. My favorite is the one over on the left. It's called the yield curve. It's the difference in interest rates between the 10-year Treasury note and the 3-month Treasury note. It's the difference between interest rates. So for instance, here, let's say it's the blue line is 300 basis points. You might have the 10-year at 4% and the 3-month at 1%, and that gap is that 300 basis points. It's the differential in interest rates. You can see it varies over time. The tan is the economy, gross domestic product. The point of the chart is the yield curve is a very good indicator of the future. So if we go back into the 70s, you can see when that yield curve, that blue line goes positive, it's followed by a recovery here. Same thing in the 80s, hard to see there, but also in the 80s, the blue line goes positive, recovery. Same thing in the 90s, the 2000s, 2007 led to our recovery. And look where the line is now. It's strongly positive. So I really think this tells us that we're going to get a continued recovery. Indeed, that's our forecast for the next 2 years. Here's an index of economic indicators that's supposed to tell us what happens over the next 6 to 9 months. Obviously plummeted during the pandemic. Well, we've had the 3 biggest readings ever recently in this index. So there really is very good hope looking forward. Business confidence is very strong as measured by this ISM index. Basically, when it's above 50, It means expansion. And look where manufacturing has rebounded to. Very strong. Services, very strong, above 50 as well. Corporate profits, well, they took a gigantic hit for 2 quarters. That's the worst 2 quarters ever. Gigantic rebound. So this is very strong. The only one that was bigger was the Great Recession, where we had this huge collapse and a huge rebound. This really tells a better story, I think, a more solid story. Corporate profits are good. Profits mean that people can be employed. So this is a good thing. So the question is, I mean, overall, we think, you know, despite the worries about COVID, and it is a substantial risk, GDP next year, we think, is going to be strong at 3.6% growth. That's pretty strong compared to the last couple of decades when it's been about 2.2%. This will be a good year in terms of growth. It doesn't get us back all the way to previous levels of GDP. And that's what's shown in the chart on the left. Each one's a different recession. Like I did before, here's the 80 recession. Got back to recovery in a few quarters. The table shows on average, it takes about 6 quarters, a year and a half to get back to previous levels of output. So that puts us at, you know, close to 2022. We'll get back there. We're making a recovery. Strong next year, probably good in 2022 as well. But there's that COVID risk that's sitting out there. If that causes us to shut down again, that can put us in an even deeper hole. Now, I'm trying to get my timer up here. So I want to look at COVID one more time. Oh, I'm sorry, I have 2 different presentations. This is what I want to get to, is that COVID is the biggest risk to the economy. If we have to do more shutdowns, that will be could really dig us in a hole. Conclusions are, we were lucky to get out. Really, we're lucky to get out last year. Huge losses and everything, but the government responses helped. This year, we're going to see a serious increase in bankruptcies. COVID is surging, but the vaccine is coming. It's just the rollout is slow. We need that to increase. Not hopeless at all. Good indicators for 2021. It's the COVID that is the risk. If we can't get it under control again, we can't get the vaccine rollout going, my fear is we'll have to have more shutdowns. So really a hopeful outlook with some big risks sitting out there. So that's my thoughts on the moment. We've got a lot of research like this on our website here. It's all free. I urge you to go take a look at it. And Cassandra, I'm hoping you have some questions for me.
I can ask the first question if I may. As always, Dan, a very, very insightful presentation. Again, as Cassandra said, we've been looking forward to you coming and sharing with us where you are. We'd love to see more of you now that you have more connection in Talbot County. We love to see you again in our chamber meeting, Rotary meeting, and other places.
Thank you.
Quick question for you. You're welcome. 2 questions. One is, there are a lot of talks about the recovery being a W shape versus a V shape, that it sounds like your graph still shows. The second part of it is, what about the role of the other part of the role of the government in other parts of the economy, especially the infrastructure? Do you think this would be a right time for the government, although we are our national debt is hitting high and everybody else is looking again at the government to give them a check? But what about spending some on the infrastructure and the places that we can create some new jobs, especially for those who lost their jobs forever?
Right. Okay. So when I get 2 questions, I usually have to ask you to repeat them, but I think I can get this one.
Okay.
The first question was about the shape of the recovery, and basically what they're referring to is the collapse in GDP. And if there's a really sharp recovery, that's a V. Or if there's a collapse, recovery, and then another collapse, that is a second recession, that's a W. We think there's going to be a steady, almost sort of U-shaped overall. But within that U-shape, there's what we call the K-shape. I mean, it gets a little silly, but what it means is, let's see if I can get this right, it's going to diverge for 2 different groups of people. it's going to be much harder for this group of people who had low wages, worked in jobs such as bars, restaurants, hotel. They're not going to recover as fast. And certain sectors are not going to recover nearly as fast, like commercial construction, going to have a tremendous negative impact because people aren't going to the office anymore. Travel, those kinds of things. Up here, the ones that are going to do better, obviously residential construction, appliances, pharmaceuticals, of course. So there's, and people, quite honestly, at higher income levels. So overall, we see that recovery of 3.6%, but there is that kind of worrisome split, that K shape in there. Now, question about government spending. And again, people who know me know that I am not a favor of government spending. But again, this was a matter of a virus. This wasn't a matter of people taking on subprime mortgages that they knew they couldn't pay back, or banks taking on too much risk that they couldn't pay back. It's a virus. People need help. You can't just shut down the economy without making, without pumping money back into the economy. We're borrowing it. We'll have to pay it back in the future. Causes more debt, but it's the right thing to do. And since we still have 10 million people unemployed, we may have to do that again, which leads to the infrastructure package. That's some political thinking, which is that, okay, we probably will need another round of stimulus. One way to do it might be with infrastructure. That's the first that comes to everybody's mind. I'm hopeful that that's the case, and it'll probably be more easier now with an all Democratic legislature, which has its pluses and minuses, but that's more likely to go through more easily now. And by the way, Republicans like to spend money just as much as Democrats do. So that's a long-winded answer, but like to.
Thank you, Dan. Go ahead, Cassandra.
Do we have other questions? I can't see everyone, but we had asked that you type your name in the box. I'll call on you if you have a question.
I have one question.
Okay, Walter.
My question is on the rent situation where the governor allows people to stay a certain length of time. But the government got to realize that people in the rental business have to survive too. And that can put us out of business. You say a small businessman goes out in 27 days. Well, how can we stand it if we go a year without rent?
You're spot on. People tend to forget in economics, they tend to look at one side. There's always two sides. And I've been saying this for a while. Who's going to bail out the landlords?
That's what I'm talking about.
Yeah, the tenants are getting bailed out, and it's kind of the humane thing to do, not to kick people out because they're unemployed from a virus, but the landlords are going to need to be bailed out as well. Landlords have bills as well. So, people do forget that there are two parts of this. And my guess is that as we go forward into this year, there will be a realization that you're going to have a lot of businesses and a lot of landlords go under. And that's not a good thing for anybody either. We need businesses to survive so that we can have employment. So it's a forgotten thing, but I didn't forget it. Landlords need help too. And it's my hope sincerely that they'll get that soon.
Thank you.
We have time for one more question. Does anyone else have a question?
Okay.
No other questions. Dan, you were amazing. Thank you so much. It's